Thank you, Tom, and thank you, Shares Magazine and AJ Bell for having us today here at this lovely event. Good evening, ladies and gentlemen. I am CFO of OPG. My name is Dmitri Tsvetkov, and I'm going to take you to a fascinating country called India. You can read this on your leisure. And OPG is a power generation company operating in India, and it is a very exciting sector, and we believe that we are in the right place, in the right economy, and I'm going to tell you the full story, and hopefully you will be convinced by the end of my presentation. India is the third largest consumer of power in the world after the US and China. But despite on this, the consumption per capita is one of the lowest in the world. It's just a little bit above 1,000 kilowatt hours, far behind other BRIC countries like China, which is just under 4,000 kilowatt hours, and Brazil, 2,500, and far behind developed countries. What is worthwhile to note that even in comparison with world average electricity consumption being just under 3,000 kilowatt hours, India is very, very behind. What does it say? With growth of GDP at around 7.5% per year, surpassing China last year, India is going to quickly catch up in terms of consumption per capita. There are 1.3 billion people in India, very young population, fast growing, and historical facts show that there is a direct correlation between growth in GDP and consumption of power. So we believe, as many other experts, that there will be around 6.7% annual growth in consumption over the next 4 years. And there are a number of drivers in India which underline this growth in demand for power. Indian government is promoting a number of initiatives like 24/7 power for all. You probably know that there are still around 300 million people in India without any access to power, but the state and the government are quickly catching up on this. Also, they're developing smart cities, housing for all schemes, and there is a push for manufacturing in India, so-called Make in India scheme. Also, there is a trend for young people to move from rural areas to the cities, so industrialization and urbanization are undergoing. And also, there is a very ambitious target announced by Indian government by 2030 to have 100% of electric vehicles. So I'm not sure this will happen exactly by 2030, but still, it's a very ambitious goal. So what is OPG's business model? As of now, the company has around 476 megawatt of capacity, which is comprised of 414 megawatt of thermal coal-fired plants in southern India, in Tamil Nadu, and city called Chennai. And last year, we commissioned 62 megawatt of solar projects in Karnataka state. We also have 46% equity interest in a Gujarat plant, which is 300 megawatt. It's here. But we deconsolidated this plant last year, and I'm going to be talking about this a little bit later. So the company got listed in 2008 on AIM, and pretty much every year it delivered growth in capacity. So in the period of 5 years, 4 units were built in Chennai, 2 units, 150 megawatt each in Gujarat in 2016. And last year, we've commissioned 62 megawatt solar projects. So we have a nice portfolio of thermal and renewable plants, and we have established platform for growth in terms of profitability and return to our shareholders. Also, it is worthwhile to mention that the company operates its plants. We build our plants by ourselves by doing EPC, land procurement. So we have a full cycle expertise in power generation sector. At the core of company's strategy, we have so-called group captive model. In India, all the tariffs are state regulated, and there is so-called pyramid of tariffs for different types of customers. So, for example, at the bottom of this pyramid, there are people like farmers. They don't pay anything. They're getting power for free. And they are getting subsidized from higher tariffs paid by industrial commercial customers. So our target is this top part of the pyramid. We offer a discount, 10–15% discount to state-regulated tariffs to industrial commercial customers, and we offer them reliable 24/7 supply of power. So effectively, it's a win-win situation when our customers getting cheapest supply of power and on a reliable basis. And we are getting the best customers who are very good paying customers, paying within 35–40 days, creditworthy. And we have multi-year contracts. We have uncapped return on equity. And it's a great business model. In terms of diversification, we have more than 200 industrial commercial customers, which are comprised of various industries like textile, foundry, steel, petrochemicals, automobile. And there is no reliance on any large one or two customers. So we have diversification in terms of customers. We also have multi-year sales contracts. And we have very good cash cycle because our customers are paying very quickly. So under the group captive model, our customers become shareholders in our Indian SPV, but they're not after equity returns. They're looking for reliable supply of power. So we are getting all the economic returns, and we are getting the best customers. So it's a win-win situation. At the core of our sustainable operations is full compliance with environmental and health and safety norms. We are compliant with all the standards in terms of emissions. Our boilers are designed in such a way that we can burn different type of coal. So we can choose coal and blend it with other sources of coal, which is providing the least amount of emissions. Also, we are utilizing air cooling systems for our turbines, which allows to save water. We consume only 1% of water in comparison if we use the water cooling systems. And we have culture of safety throughout the whole organization. We had 0 incidents this year, which is very admirable. And we are targeting always to comply with all the best practices at our plant. So a few weeks ago, we've announced full trading updates, and we issued a press release. And by the way, our financial year is from April to March. So we just finished our year FY19 in March of 19. And now we are currently in FY20. So in FY19, we had 2.7 terawatt hours generation. Our tariff was 5.4 rupees per kilowatt hour, which is approximately around 6 pence per kilowatt hour. And we increased our tariffs by approximately 10% last year. We also had 75% plant load factor, so-called PLF. PLF is effectively how effectively the assets, the plant is utilized. Just to give you a comparison, our Indian peers have around 59% PLF factor. We have 75%. So we are utilizing our assets much better than our peers. And actually, our target is to have above 80% PLF factor. And our debt is just around 80 million pounds. This is gross debt. And with EBITDA for the current year, for FY20, expected to be more than 40 million pounds, you can see that our debt to EBITDA ratio is just 2 to 1, which is very, very decent. This is just a historical performance of our plant. So you can see the generation increased from 2.2 terawatt hours to 2.5 terawatt hours. Our PLF factors increased from 73% to 75% over the last 3 years. And as I mentioned, we were expecting to have more than 80% PLF factor, but there was a unscheduled maintenance shutdown for one of our 4 units, which effectively reduced the PLF to 75%, which is still very good result. But for this year, we're expecting to have 80 and more % PLF. And we are deleveraging every year. So you can see that we are repaying debt consistently over the last several years. Last year, we paid approximately 20 million pounds of debt. And Unit 1 out of 4 units in Chennai plant was completely debt-free in December. And by 2023, we are going to be completely debt-free for all the 4 units. So by paying down 20 million pounds approximately per year, we are directly creating equity value for the same amount, but also we are reducing our interest cost by approximately 2 million pounds. So in 4 years' time, this company will have pretty much 0 term loans debt, and it will be generating between 40 to 50 million pounds EBITDA on annual basis for another 30 years. So it's going to be a very attractive cash generating, and it is cash generating and very profitable at this moment, but it will be even more attractive in a few years' time. And these are the historical results. We will publish our annual FY19 results, audited numbers in July. So as of now, I can tell you that last year, revenue was around 140 million pounds. Half-year results, we had 78 million pounds. And Tsvetkov is forecasting for FY19, sales will be around the same number, 140 million. It was supposed to be much higher, but Unit 4 was under unscheduled maintenance shutdown, which I mentioned earlier, so this reduced our numbers. But we are still in line with market expectations, so we have robustness and, in our model. And our EBITDA, just 2 years ago, it was 52 million pounds. Then last year, it dropped to 24 million because of cost of coal and volatility of international coal, and I'll talk about this later. And for FY19, our broker Tsvetkov is projecting to have EBITDA around 34 million pounds, and for this year, FY20, 41 million pounds. So you can see that when we are talking about EBITDA of 40 plus million pounds, it's very achievable. We had it even above 50 million pounds. And we are profitable, and over the last 2 years, we paid dividends. 2 years ago, we paid just under 1p per share dividend. And last year, we paid scrip dividend, which is a dividend in shares, which actually was very beneficial for our shareholders because upon conversion to shares, it became 8-9% dividend yield. So the biggest volatility in our business is cost of coal. You can see here on this graph, cost of, it's a spot price, historical price for 4,200 GAR calorific value Indonesian coal. And we buy approximately 95% of coal from Indonesia. And you can see that 3 years ago, cost of coal was just under $30 per metric ton. And then last year, it increased up to $50. We believe that if you believe that the world is becoming greener and low carbon, there will be you will expect that cost of coal will go down. And that's what happened just last year. And you can see that for FY19, average cost of coal was just under $40, while last year it was $44. As of now, cost of coal is around $39. And historically, you can see it was fluctuating between $37 and to $40 between 3 and 9 years average. Yesterday, we've made an announcement that we've entered into the fixed price contract, coal purchase contract for 1 million tons of coal, which is approximately 60% of our annual consumption. And this is a completely game changer. We worked really hard to get this hedging in place. Now, effectively, we are locked in our profitability. And we have much better visibility in terms of our results for this year. Share price jumped 5%, and I expect that the trend will continue. So in terms of our priorities, first of all, we want to focus on maximization cash flow from existing assets. So we are operating our plants at good PLF factor, much better than our peers. We increased tariff last year. By the way, our tariff is somewhat linked to state-regulated tariff, the formula. So whenever the state is increasing the tariff, we are benefiting from this as well. Over the last several years, the state didn't increase tariff. So there is an expectation that this summer there will be an uplift in tariff, and then we will benefit from this uplift. We didn't take it into our forecast because it didn't happen yet, but that's an upside. Also, as I mentioned, coal prices are expected by all experts to continue going down. And by next March in 2020, it is expected to go down by another 10%. And we just locked in fixed price arrangement for around 60% of our coal consumption. So it gives much more visibility to our results. Safety, as I mentioned, is very critical for us. We will continue to be compliant with higher standards. And we will continue deleveraging. We paid down 20 million pounds last year. We will pay down approximately 20 million this year. And in 4 years' time, this company will be debt-free. Just to give you a little bit of math, comparing typical multiples for our type of companies is around 8-9 times of EBITDA. If you take even conservative forecast of 40 million pounds for this year, our enterprise value should be 8 times 40, 320 million pounds. If you deduct debt, 80 million, we should be trading at around 260 million pounds equity value. As of now, we are trading at 73 million pounds. So we are trading at less than 30% of fundamental value. And in a few years' time, the company will be deleveraged, and it will be just generating cash. So I think we have quite an interesting story here. But the story wouldn't be complete without giving you some past performance. This is our share performance over the last 3 years. You can see that our shareholders suffered quite a lot over the last 3 years. And the reason for that, the major reason, was the Gujarat plant, which I mentioned earlier. So the group captive model, which I mentioned before, is a central law. But in Gujarat, when we built the plant, the local authorities were not fully understanding the model because we were the first group captive company. And they didn't accept group captive status of our plant, which created quite a lot of stress because they were charging cross-subsidy surcharge, which amounted to around 40 million pounds at the end of a 3-year period. So we had a stress in the one entity, but the market was interpreting this as that the whole group is in trouble. So last year, we've deconsolidated Gujarat plant because we decided to focus on sustainable operations of Chennai plant and solar assets. And immediately, when we announced half-year results, our share price in November of last year increased by more than 100%. So we're still trading at a huge discount, more than 70%, but it will take time. Market has to see when we deliver the numbers, when we meet the expectations, and then with the time, this discount has to be eliminated. So basically, what I'm trying to say is that now we have a different structure, much more transparent, much more simple to understand, which is simple to value. And our shareholders are comprised of 51.5% is owned by Mr. Arvind Gupta, who is our executive chairman and founder of the company. And we have a list of blue chip institutional investors, like M&G owns 13%, Riviera Mercantile just under 5%, Premier has under 4%, British Steel Pension Fund, and some other funds. And we have around 14-16% of retail investors. And we are targeting to increase our retail shareholder base because it's very important to have a proper shareholding structure. That's one of the reasons I'm here. So without further ado, I would like to open the floor for questions. Unfortunately, I will have to catch an early flight, so I will not be able to stay for drinks. But Simon, who is sitting here, he will be able to answer other questions if I'm not able to answer something right now.
Thank you very much, Dmitri. Any questions from the floor? One just here.
Hi, I've got a couple of questions for you. Where do you buy your coal? And do you have to invest in infrastructure like grids and wires to get to your customers? And you mentioned SPV. How does that impact the investment proposition from a perspective?
So your first question about coal and infrastructure. So our plant is just 40 kilometers away from the port, and we can import basically from any part of the world. We chose to import from Indonesia because this is the cheapest option, but we can do it. We can import from South Africa, from Australia, from anywhere, from India. So in terms of infrastructure, it's very simple. We just the vessel comes with our coal, it's get unloaded, and it's shipped by trucks to our plant. And we have fleet of 50 trucks who are operating every day. So in terms of shareholding structure, investors are not affected by the structure of Indian SPV because you would be investing in the top company, which is Isle of Man company, OPG Power Ventures PLC, listed on AIM. And shareholders, group captive customers, shareholders are in Indian SPVs. And we are getting 99% of economic interest. They are getting only very small percentage. Even though they have shareholding, by law, they have to have shareholding. They're not getting any significant equity interest in results. And they're not after equity results. They want reliable supply of power. It's just the way to structure to meet all the requirements of group captive status, which is beneficial for everyone. Is it clear? More or less?
A wee bit.
Simon can answer during the break even more comprehensively.
Do we have any other questions from the floor? I think one just here, gentleman. Just.
When do you think the company would be able to be listed in FTSE 250 in the future? Do you know, I mean, the duration?
Well, in terms of, it's a very, very good question because the company, by the way, I've been with this company just a little bit over 2 years. But before that, the company was considering to, and planning actually to move to the main market and to become a FTSE 250 index. But there are a couple of main criteria. One of them, corporate governance, which we comply to a large extent with. We have a board. We are compliant with most of the provisions of main market. The second criteria is obviously market capitalization. So if we, and I don't remember exactly what is the threshold for FTSE 250, but I think it's around 600 million pounds. So we are currently at 75 million pounds. I hope that I've proven the case that we should be around 300 million pounds, right, with existing assets. But we still have a little bit way to go to meet this threshold. So it might happen if we grow faster than we expect in terms of market capitalization. The company is ready to become a member of FTSE 250. And personally, I have experience of working with companies of premium listing of FTSE 250. But AIM is also a good market. It provides exposure to various shareholders. So it's outside of our control to a large extent, if I can answer this question.
Thank you very much. Any other questions? Just the lady behind. Thank you.
Hi, I was wondering whether I might be able to ask about foreign currency. So I'm sorry if I'm making a few assumptions here. So I'm assuming that if you're buying coal, it's in US dollars, sales in a different foreign currency and presumably reporting in sterling.
Correct.
How are you planning to kind of mitigate against kind of foreign currency fluctuations, particularly in the next 12 months?
Okay, excellent question. So the biggest exposure is from Indian rupees to US dollars for purchasing coal. We are buying forward contracts, so we hedge for foreign exchange. Currently, it's around 80% of our exposure. In terms of reporting to GBP, we don't have significant expenses in GBP, just corporate expenses and G&A. So we just apply whatever exchange rate at the end of the period and average to translate our results from Indian rupees to GBP. So fundamentally, it doesn't change anything because it's just reporting currency, and we disclose the assumptions and the FX rates which we use, so investors can see clearly how we performed and whether we met our expectations. So just to repeat again, for the current year, we are on track to meet market expectations in terms of profitability and other parameters.
Great, thank you. Any other questions? I had one sort of quick question, if that's all right, Dmitri.
Absolutely,
So, just wondered what your plans maybe are for the medium term and whether you're looking at developing or entering any new projects alongside the ones that you already have.
Mm-hmm. So there are plenty of opportunities in Indian power sector. There are a number of distressed assets which are available at the market, and renewables projects which come to our assessment. What we realized, having our Gujarat experience, that it is very critical to grow responsibly and to keep leverage at the manageable level, even if it's perceived level. So with Gujarat, when we built the plant in 3 years ago, it had quite significant level of debt because it's infrastructure project. 75% of funding is coming from term loans. That's typical. But when this plant became into stress, the market assumed that this is a debt of the whole group, and therefore there was a wrong perception that we have guarantees or cross-corporate guarantees for this plant, which wasn't the case. So to grow responsibly, we will choose the project based on 2 criteria. First of all, profitability. It has to make sense for the company and for our shareholders. And second, we will not over-leverage the company. We will find the structure in which it could be a joint venture when we can provide our expertise, we can operate the plants, but the funding will be coming from the third sources, from some financial institutions, directly to the acquisition companies. We will also look at growing at our renewables portfolio, but again, it's based on profitability and based on a reasonable capital structure. At this moment, main objective is to reduce the market discount because we have great assets, profitable, cash generative, but we have a very significant discount, more than 70% discount to market through fundamental value. So we have to demonstrate to the market that we are meeting expectations, we are providing the results which beat results or meet the expectations, and only by doing this we grow, not in terms of capacity, but in terms of market capitalization.
Excellent.